California, Colorado, and Texas face a billion-dollar home insurance dilemma. First, let's take a look at California's growing wildfire risk for home insurance market. California homeowners face a growing problem. Over 1.2 million homes are at moderate or high risk of wildfire damage, with reconstruction costs exceeding $760 billion. According to CoreLogic's Wildfire Risk Report, this is particularly concerning for those living in the wildland-urban interface, especially in areas like Los Angeles, San Diego, and Riverside. Climate change is a significant factor, with NOAA's data showing the number of acres burned each year has nearly doubled since the early 80s. Reconstruction costs for damaged homes have increased by 33.5% over the past 5 years, partly due to inflation and labor shortages. California homes at high-risk counties are Los Angeles, Riverside, San Bernardino, San Diego, El Dorado, Fresno, and Sonoma. The California FAIR Plan, a last resort insurance option, offers limited coverage, meaning many residents need additional policies for full protection. Did you know that human activity causes 89% of wildfires, often through everyday actions like burning debris or equipment malfunctions? The financial burden extends beyond rebuilding to finding stable, affordable insurance. CoreLogic's data suggests the average annual loss for California homes could rise by 31% to 41% by mid-century. Homeowners need to stay proactive by creating defensible spaces and pursuing ember protection retrofits to lower risk and potentially manage insurance premiums. Securing comprehensive wildfire insurance is increasingly challenging in high-risk zones. While some companies exit the market, alternatives like the FAIR Plan step in, but with limited protection. CoreLogic emphasizes the need for advanced wildfire risk assessment tools to improve preparation and potentially lower costs for homeowners. Now, let's take a closer look at Colorado and Texas. While California often dominates headlines when it comes to wildfire threats, it's crucial to recognize that significant risks loom in Colorado and Texas as well. Colorado is home to more than 300,000 residential properties at risk of wildfires, with a staggering total reconstruction cost value of $140 billion. The state's vulnerability is particularly pronounced in metro areas such as Denver, Colorado Springs, Fort Collins, Boulder, and Pueblo. These regions are characterized by their proximity to wooded areas and mountainous terrains, making them highly susceptible to rapidly spreading fires. Similarly, Texas faces its own set of challenges with 200,000 homes at risk, amounting to a reconstruction cost value of $85 billion. The areas of Austin, San Antonio, Killeen, Dallas, and Waco are identified as the most vulnerable. These cities, with their mix of urban developments and surrounding brushlands, are increasingly at risk as climate patterns shift and drought conditions persist. Insurance challenges and market trends. With increased wildfire risks, insurance costs are rising and availability is diminishing. Many homeowners find themselves in a difficult situation, with policy renewal costs seeing significant increases. State Farm and Allstate's decision to halt new policies in high-risk areas signals broader market trends where traditional insurers are retreating. Insurance Commissioner Ricardo Lara has introduced regulations to ensure fairness in underwriting processes. However, insurers argue that stringent rate control regulations prevent them from adjusting premiums quickly enough to match rising claim costs and natural disaster frequency. California is one bad fire season away from complete insolvency. Assemblymember Jim Wood. This observation underscores the situation's fragility. Insurers are bound by processes that can take over a year, affecting their ability to respond to rapidly increasing risks. The FAIR Plan provides some relief for those in wildfire-prone zones, but offers limited coverage at a higher cost. Mitigation efforts are crucial for homeowners facing heightened wildfire risks. Structural hardening, measures like ember-resistant vents, fire-resistant roofing, and creating defensible spaces around homes can reduce physical risk and potentially impact insurance costs. Community-level efforts, such as coordinated fuel reduction programs, improve the resilience of entire neighborhoods. These collective actions foster a stronger defense against wildfires. The escalating wildfire risks in California, Colorado, and Texas present a formidable challenge to the insurance industry, threatening to destabilize traditional business models. These three states, with their dense populations and vast areas prone to wildfires, represent a significant portion of the potential financial losses that insurers must manage. The sheer magnitude of homes at risk, totaling over $225 billion in reconstruction costs, underscores the potential for catastrophic impact on the industry. By leveraging technology, companies can better predict and mitigate potential losses, providing a buffer against the financial shocks of devastating wildfire seasons. How is the industry adapting innovative approaches to underwriting and claims processing further enhance insurer appeal? Companies are embracing technology-driven solutions, such as AI and machine learning, to streamline operations and improve customer experiences. These advancements help in swiftly addressing claims and reducing administrative costs, ultimately enhancing profitability and investor returns. While the challenges are significant, the insurance industry is demonstrating resilience and adaptability. Thank you for tuning into our insurance news segment. We appreciate your viewership and would love to hear your thoughts on the rising costs and concerns about wildfires in various states. Your insights are important to us, so don't hesitate to share your opinions. And remember, hit that subscribe button so we can keep this important conversation going. Stay informed and stay safe.